Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Audio participants, if you have any questions, please press star and 1. The first question is from the line of Atul Ambawar from Ambawar Associates. Please proceed.
Yeah, I have a question relating to FDI in completed assets. So, just wanted to ask if now it is with the changes coming in, whether it is permitted in pre-leased properties.
Yeah, so the regulations obviously allow you to invest in pre-leased or income-generating properties, whether it's a shopping mall or a
business
center, and the definition of business center is wide enough to actually cover any kind of commercial complex the way it is.
So even standalone properties are now covered?
Yeah, yes they are.
Yeah. Thank you so much.
Thank you. A reminder to our audio participants, if you have any questions, please press star and 1. Next question is from the line of Ananjit Sundaraj from Peninsula Brooksfield. Please proceed.
Hi, yes. Hi, good evening, guys. My question is on the 3-year maturity or the lock-in that we have. So you said the maturity principle could be the ECB maturity principle. So could you just give us some color in terms of, I know it's still not very clear, that's what the panelists had said, but in terms of the ECB maturity principle, what does it mean? And is there a way to shrink down the 10-year period, someone had mentioned? So how does one do it? Would be very insightful. Thank you.
So there is obviously a lack of clarity is what I said, and based on the discussions, the most recent discussions that we've had, and we are expecting something in written, is that it's really the average maturity as you compute from the ECB perspective, and the term duration is used more in a generic sense. But obviously this is only oral right now, so there are different views of computation which are still prevailing. So I think you should consult your custodian also, and also have separate meetings, because duration can only be done by Macaulay, but have your discussions. But most recently what we've heard is that RBI has insisted that it will just be the ECB kind of formula, and the term duration is used in a more generic sense.
Okay, thank you.
Thank you. We would like to remind our participants that you may press star and 1 if you have any questions. Next question is from Saloni Shah from Asia Associates. Please proceed.
Hello. Currently in the LSP, 50% FDI is permitted where no FDI-linked performance conditions are there. Now in real estate, if the two major conditions, that is minimum area norm basis, wouldn't this now permitted in LLP?
So we already mentioned that
Yeah,
that LLP is not allowed for real estate.
LLP is not allowed for real estate because one of the performance link condition of lock-in for 3 years is still there.
So lock-in will be considered as a performance linked
That's
condition.
correct.
Yeah.
That's correct.
Okay. Okay, thank you.
Thank you. The next question is from the line of Keval Bilde from PwC. Please proceed.
Hi. Since now FDI is allowed, whether an outside trust.
Mr. Bilde, your voice is breaking, sir.
Yeah. So is it clear now?
Yes.
Yeah. So since FDI is allowed in LLPs, just wanted to understand whether an outside trust can invest in an LLP.
So again, if the question is from the context of real estate, as we mentioned, FDI in real estate LLPs is not allowed because the real estate sector still has the condition of lock-in. So whether a trust invest in LLP or a corporate invest in LLP, for real estate LLPs are still not allowed for foreign investment.
And for the other classes, I think you should determine who the for non-real estate, say operating company and all, you should determine who the trustee of the trust is, because LLP can only have individuals or body corporate as a member or as a partner. So it will determine on who the trustee is.
Okay, thank you.
Maybe
Thank you.
just
As there are no further questions from the audio participants, I hand over the conference to Mr. VYAPAK Desai for closing remarks.
If we have any questions from
we can open the floor here as well.
As far as NRIs are concerned, you clarified that now NRO account money will be treated as not as a foreign currency investment.
correct.
So if NRI transfer first to NRE account and then transfer from there to NRO account, the color will be, is it the NRO meaning only the original Indian money, or is it that transfer from NRE to NRO is permitted?
No, so the important thing is from which account the investment was made.
NRO.
Then it will be considered a
Though
domestic
even the
investment.
source is NRE.
Yeah.
Recently-
Because once it's in NRO account, when you exit, the money will go to NRO account only, and there is a limit of $1 million. That's the maximum you can take out in a year. So that's where the restriction with the government wants, or the checks and balances with the government wants, is there in the NRO account.
Recently, in a SEBI has clarified, in a security transaction where NRIs who were transferring money to NRE first, then transferring to NRO and buying the shares of B category shares, where as you must be aware, you can only buy up to a certain percentage of the
Correct.
shareholding.
Yeah.
And where it exceeded,
Yeah.
the SEBI has taken a view that if the original source of the money was NRE, then this NRO will not qualify to exceed beyond that particular limit.
Is there an informal guidance on that, or is just
No, that was
verbal
a live
discussion?
case which we took up with SEBI, and they have clarified
Okay.
that we will not
that
permit.
that may be
Okay.
more from a
Whether
listed
will that
Yeah.
index
work here,
perspective.
that was
Sure.
not required.
Sure.
Yeah.
Okay.
Yeah, this question is for Karan. That you mentioned that you were amongst the first guys to use the platform,
That's right.
and it has been successful. Yet you're talking of going to the fund structure.
Correct.
So can you just give what are the advantages that you view in a fund structure over your existing platform structure?
Yes, I think the advantages are twofold. One, to us, that's our business model, right? So we want to proceed with us, and the economics change quite drastically from a platform structure to a fund structure. So that's one. I think the other thing is that a fund structure is really a bespoke structure. So when you go and meet an investor, typically an investor who's not very large or very sophisticated, like the types who we've seen coming into India, like an RDR, APG, or CPPIB or somebody like that, their expectation is that you come to them with a fully laid out bespoke structure that takes care of their investments all the way to FDI and the repatriations all the way. So as I was actually bringing up on the panel, like while we're able to sort of work with these structures and innovate, some of the problems that we face is that the structure itself has a lot of gray areas. And that is something we're trying to work with, from our own corporate side as well as the advisors, to see if we can address some of those issues and make it more world-class and black and white.
Thank you.
I have a question. On the token of 3 years, is it possible now to go ahead and sell the piece of land that is essentially the asset in the company that we've invested in?
Not before 3 years.
After 3 years, I can go and sell the land?
Yeah. But only thing is that from a spirit perspective, you should have at least made some development or at least efforts to develop the project. It can't just be that money comes in for the purchase of land, foreign money comes for purchase of land parcel. Nothing is done for the development of the project. You sit on the land for 3 years, and after 3 years you sell the land. I think that's something which from a spirit perspective is not something which the government is
That will
looking
not
at.
tantamount to real estate business.
That
The intent, as you're saying, is that his intent was never to make profit out of sale of land.
Yeah, see, so that's what I'm saying. So one is intent, and also whether you are able to demonstrate yourself to tomorrow if there is an inquiry which comes from the regulator. None of the opinions, nothing is going to help you on this. What will help you is you able to demonstrate that I made efforts, something which is beyond your control to develop the project in the first 3 years. If you are able to demonstrate that, and then you say that okay, we have not been able to do anything, and the project couldn't start, and now we want to exit by selling the land. I think that's something that we can take a view that because all efforts were made and it was done in a bona fide manner. it should be fine. But at the same time, there will always be this element of risk involved when there is no development which has taken place, and there is something which was out, within your control, and you didn't do it.
I think the question is, let me also add, this 3 years is nothing new. This was also in Press Note 2 2005. And therefore, I think the question should be, there are two separate elements that you need to address. First is the issue of capital account transactions, where real estate business is totally prohibited. The other is construction development, right? So the way you look at it is that, what was your intent first? Let's say you were trying to set up a wind farm. You buy land for it. You do your feasibility study. The land is not suitable. You sell off the land. Are you real estate business? No. You were trying to set up a wind farm. So you're an operating company. So your first step is to set up and to intend that what is your intent. And intent can't be just that you write in a board meeting. I think it has to be a genuine and a bona fide case of establishing what your intent is. The second concept is, now what happens if you set up a company, but for some reason, even despite your all efforts, because you're only an investor, you could not do it for those bona fide cases. How long should you be held up? Because we wanted commitment to capital. Those commitment of capital you've demonstrated. So how long should you be held up? So we said it should be a bench. It can be 3 years, 2 years, 5 years, whatever. The policy talks about a 3-year benchmarking process. So 3 years, if you fulfilled, then technically you can exit. You can exit before if the project is completed. You can exit before the trunk infrastructure. So there are two very independent processes. And whenever you're talking about, in the larger context, whenever you talk about issues of, assuming 3 years, please, no one should assume that you can do speculative land trading activity, come in, hold the land for 3 years and then just sell off and make windfall gains. No, that's not the idea. This 3 year is a benefit given to bona fide investors who, despite their efforts, could not do anything. That's the idea.
So I think obviously when you are exiting, no one is going to stop you from exiting. It's only post that if questions are raised, right? And at that point in time, if you are not able to show on paper and by not only intention but by conduct that there was enough done to develop the property, I think obviously there would be a problem. So again, some of these provisions will have to be read, as he's saying, from a spirit perspective. That idea is to try for 3 years. If not, then at least you have stayed for 3 years. If you do it early, you can exit early. If not, after 3 years we'll let you go.
And I can tell you some of the questions that the FIPB would ask you. Did you have a project monitoring committee? Did your board meeting evidence that? Did your shareholders meeting evidence that? How soon did you meet? What were your challenges? Did you push for it? Did you push for approvals? What applications? I think the concept is you can do everything what you want to do if you want to be cute. I think the question is justify to your own conscience. Were you really trying to develop and you couldn't do it? Then I think you're in the clear. If you can't justify to yourself, you can't justify to FIPB for sure.
I have two questions, one to RUCHIR and one to NISHCHAL. First, RUCHIR, you mentioned that in last 10 years cycle, it was earlier equity, then pure equity, then listed NCD and listed NCD, and now again back to the equity. What's the particular reason any of that? That's question number one. And come back to question number two. It's really encouraging that now the real estate FDI again it's in a good spirit. But we are also hearing that the RERA is also going to come. If RERA comes, the real estate development and regulations, there is a restriction of putting 50% of the amount from the sales proceedings of the apartment into the escrow. Will it have an impediment from the FDI point of view, investing into this?
Yeah, so maybe on your first question on why did the flavor change from equity to debt. 2005 was when we just opened up, everyone was buoyant. People and our mothers tell us, two things essential: buy gold, get married, and buy real estate, right? So these three things became very important.
Not very different than Japan.
They're not very different than Japan. Even China, by the way, I was told that in China, no man would give their daughter unless the boy had real estate. So that build up a perception that real estate will grow enormously. And people promised whatever to their LPs, enormous returns, exorbitant, returns which were not possible, 25, 30, 35, 40, whatever numbers were floating around. I think over the years, there was a tempering of those expectations. We realized that real estate is at the end of an asset class. It's a stable asset class and it will grow on a stable basis. So the returns cannot be measured with, cannot be those exponential. Once the returns are stabilized and there is a hard asset, and somewhere down the line, some of the promoters also acted very cute and tried to arm twist the promoters, arm twist the investors, and I think that's where the interest and that's where the mentality also came in to secure or to have some kind of debt-like mindset. And unlike tech or somewhere where a private equity investor is seen like getting a tremendous amount of value, real estate, no matter what you say, a promoter only sees you as a money lender, expensive or a cheap money lender. So I think the mindset was kind of driven by that to some extent, and the kind of cases that happen. So tempered expectations of around 20%, which you could get even in case of debt, security creation, and coupled with that, the stable cash flows which keep coming in real estate. So you don't really have to wait for 5 years. On day one, you're having it. So the model's entirely changed, and obviously there are different parameters for equity, different for debt. So now with some people who've done equity have actually taking equity like any other asset class, like tech, like you're investing into a brand which is into construction services. That's not really real estate investment, I would say. It's more like investment into construction services. So there are different parameters for different things, but that's how debt came in and became.
I think mainly it's to do with the risk appetite. I think when the sector opened up, the risk appetite was very high. The investors invested with second, third tier developers, and they burned their fingers. And then the idea was to protect the capital, which is where the debt fund started coming in. And on debt, I think the benefit is that in case of equity, when you invest, till the time the exit happens, you don't get anything, because dividend is something which is not a tax efficient way to get money back. So as an LP, you are expecting your money back after 6 to 7 years of putting your money on day one. Versus in a debt structure, you can structure the coupon, which can keep coming quarterly, annually. At least they see something coming back, which gives a lot of comfort to the LP, especially LPs who have lost money in India. And that's where the debt investment started. And now the new resurgence which we are seeing on equity is not the same we saw in 2005 to 2008. These equity deals which are happening are with very select developers. It's not the developers who thought that having a project in Nasik you'll get $100 million of funding. Now it's very focused in metros and couple of other cities. Very select developers, like the platform deals, if you see, are happening with all the top tier developers like Pirama, top tier fund managers and developers like Godrej Properties, Piramas, and
And I think just to add, there are very few developers, Rajiva, like Tata Housing or Godrej, like you guys, with whom people want to take a business risk. You can't take a business risk with a name you don't trust. And that's why equity is very limited, very few. I think that's the bottom line of it, of all of it.
And just on your second question on if 50% is put in escrow, I don't think, first of all, it will ever get passed, given the strong developer community. And as long as that escrow money goes to the investors would be happy with that. But I don't think all those things are envisaged under the regulations.
Maybe if you can introduce and ask a question.
Yeah, sorry. So my question was, sir, you mentioned that probably there's going to be a reduction in cost of capital for developers going forward. How would you envisage that? Would it be, more from a demand-supply scenario that FDI opens up and there's a lot of demand for smaller assets now that restrictions are lifted? Or would it be more from an expectation perspective for a foreign investor that he expects more corporate governance to be there, or probably he expects to get more marquee projects which are more infill locations, so maybe his expectations would be lesser. So do you see it going down from higher 20s where it is and probably lower? In terms of cost of funding,
okay.
To you.
Alright, so I want to actually qualify that I don't agree with NISHCHAL and RUCHIR on how debt and equity panned out. I'm just qualifying that. Yeah. we can pick it up over cocktails. But so that said, I think to your question, how the investors view risk and how they sort of price that risk is where the hurdles get set. And some of that is related to sort of just all these gray areas and opaqueness that exists when they come to India. So as you go down, get more sort of transparent, governance starts to go up, I think the cost of capital will anyway come down also we think the RBI position is to bring it down. So yes, for sure we think that the numbers will come down. I mean, to use an example, we met a Chinese investor who wanted to come in here. I think Shobit met them as well. And their view was that they viewed India as much more risky than China, just because they're going outside. But they also viewed New York City, for example, as much more risky. So they had to go back to their investment committees and answer, why are you taking so much risk in going to the United States and getting such low returns? So the answer is it's just as you understand the country more, the assets more, the developers more, you start to gain comfort. I think that capital does come down.
So I think there are few people in the next room as well. They are on the screen, and maybe if you can, if anybody has a question before we wrap up, maybe you can introduce yourself and ask a question, because though you have been here, but across the wall. Anybody from the next door? Anybody has a question? Yeah, if you can ask, introduce yourself and ask. I hope we can hear them, right?
Or maybe you can.
That's
easier.
Open the door. Yeah, I know.
Yeah, you can just open the door, I'll be good.
Yeah, I think we can hear you well now.
We can hear you now.
It's an open door policy.
It's an elementary question. I missed the earlier part of the conversation or the earlier part of the deliberations. My name is Manoj Mota from Banyan Resources. The question is elementary. Has the government figured out now that assets which are income generating or income yielding are no longer real estate? And so sorry, I missed the earlier part of the conversation. If this has been discussed, then the question doesn't follow.
It's been discussed. Yeah, so for certain asset classes, the government has indeed indicated that so long as you're operating and maintaining the asset, it would not qualify as real estate business, and mere earning of lease rental income will not qualify that asset as real estate business, and FDI will be allowed.
Thanks.
It is related to completed commercial properties. Now,
if you can introduce yourself.
Yeah, my name is Jatin Nanare from India Ratings and Research. Question related to completed commercial office property. Now there are a lot of developers who has a completed commercial official properties as well as the construction business in the same company. But as an investor, I want to take a call on only commercial property only. Then in that scenario, can a developer transfer these assets because the stamp duty is so high? What is the way to transfer these assets to the maybe a new subsidiary or a subsidiary which doesn't have any construction activities?
So I think so this issue has been going on since 2005, especially for projects which are in an entity. So where there are 10 projects, but the foreign investor wants exposure only on one project, and let's say that project is a slum rehabilitation project where all the approvals are in the name of the project company, and you to transfer those approvals is it has time issue. At the same time, as you rightly mentioned, stamp duty issues. So we have done in the past some of the deals where we have created tracking stock type of structure where the foreign investment is done in the company, but that investment only tracks the revenues from the project, and the commercials are achieved by issuing different types of instruments to the promoters and to the foreign investors just with respect to that project. So you can do a contractual ring fencing of the liabilities for this project from the other projects, but at the same time the statutory ring fencing cannot happen, because tomorrow, let's say if there is a tax department wants to attach the assets, they are not going to look at your agreement, they will look at the company as a whole, and in that situation that risk is there. But yes, some of these deals have happened in the past where tracking stock has been created.
And by the way, now the exit and every FDI conditionality is to be seen on a phase wise basis. So it doesn't need to be, so every phase, and its language is yet to be clear, but I think the view that people took in press note 10 was that it had to be seen on a sanction plan basis. So it's on a phase wise basis that you see your entry, exit and other conditionalities.
So maybe we can just take a last question.
Yeah, last question we can take.
Maybe we can.
If you can, we can continue
If there are any questions, you could mail it to RE1911 at nishithdesai.com and we will respond to you.
Yeah, maybe last question.
The last question we can take, and then our cocktails we can respond at your own cost.
You said that certain investment in completed assets, they are out of real estate business. So FDI can be brought into LLP because LLP.
We already discussed that FDI into real estate LLP is not permitted.
But if it is into operating retail mall in that case?
It doesn't matter.
No.
It doesn't matter.
Because a 3-year lock-in is also applicable to malls.
So maybe Nishith, you want to help us?
I don't know if there is an appetite to listen to me because I think I'm the head of the organization. All these are the brains of the organization. You heard them very well. But very quickly, let me make a few comments.
Can we put that on mute?
Shut down.
That's another question. Is it just between a very hawkish RBI and SEBI and generally this is and somebody told them
yeah.
Sorry for that. And I think 3-4 points I thought I'll just make. First of all, we are talking about structuring transaction. Now our mindset will have to move to becoming an architect. Okay, because of the GAR, the way in which other things are coming up. So so far structure, it's a very structured thinking. Okay, so you think you do not only need a right structure. It's no longer you go on a whiteboard and get a great slide presentation. No longer. It's going to be all about documentation. How do you articulate? Okay. Couple of things on documentation. Every document that you make sure that your recitals are very well written. You must recite a commercial story. Many times you straight away write a couple of sentences and straight go into operational part. It's very important you focus on recitals because if the GAR comes, even if GAR does not come, people would want to know, is this something genuine? What was the background and stuff like that. So storytelling in the recital, which was taken as a normal, standard stuff, but now it really is very, very important. Second point, I would think is that board duties are getting more and more important, and especially FCPA, Foreign Corrupt Practices Act, when foreign investors come, this is a very important point which you must bear in mind. How things may unfold, let me tell you a little bit about that. For example, until recently, you acquired a land through improper means. Okay, you have 100 crore property, but you cannot disclose 50 crores. So your value is 50. Within 6 months, foreign investor comes and gives you 100 crores. Now, director's duty, what is director's duty? You will have to check what event has happened in between now and within 6 months that property has doubled. Because typically, so far the approach was that, okay, you get a land, you do it, everything, we are not going to be in picture, and now we are going to be, investing, so we don't look what happened in the past. But director's duty is, they need to inquire, did they have an implicit knowledge of what happened and stuff like that, because quietly somebody would always tell, oh, this is what is our cost, how can we do this, etc., etc. So director's duties are getting more and more important to see that you don't turn a blind eye, because then the governance issue will come up, and if anything goes wrong, then more questions, and in interrogations and the examinations and cross-examination, some of these things come out. Did you have a knowledge of what happened, right? Third thing, of course, we heard the chief finance. I think so far we saw most of the investors from the West and from Hong Kong and Singapore, but now we see Japan, China, many other countries are looking at India as an attractive destination. So there is a great opportunity, no doubt about this. But I think more emphasis would have to be on what are our business practices. Now time has come to change the business practices as well. You will soon see Indian companies also going global and mostly getting into real estate as a first. So some point in time, if some of you are interested, we'll have globalization of Indian companies, particularly for the real estate business outside India. I don't know how much interest is there, but we'll be delighted to look at how the things happen in New York or in Palo Alto or in Silicon Valley, or which is bustling, like there also prices are going double. at times, and London and many other countries. But this is the trend I'm likely to see, and we are already seeing number of groups which are interested in going outbound as well, because you diversify your portfolio over a period of time, because you can't have all eggs in one basket. So Indian companies would also perhaps come to Japan, okay? And the cost of capital, I think so far is cheap. But now next thing is that we would like to take your capital and charge you interest as well. So third thing is that whenever you get into any particular deal, focus more on strategy. There are three dimensions which we call strategy, law and tax. That really gives you a triangular approach. So many a times we are so stuck as lawyers or otherwise, law and tax, and we are so dimensional. But really speaking, where we need to focus on tax, on the strategy. If you know you just focus on law and tax and miss out on strategy, I think that is something that you should not. Don't be too cute, as in the words of RUCHIR. Don't be too cute on law or tax. I think just be a little careful. But strategy really plays an important role. I think this has been a great. I just walked in last minute. I didn't want to talk, but I really want to thank you. But just also want to know, how did you find today's event? Was it good? I think there has been overwhelming response. We couldn't accommodate people here. We couldn't accommodate in the next room, and also we had to close a lot of registration for people who have been on the call. But I hope this has been helpful. Are you all?
Yes.
Okay, so can we give a round of applause to all the panelists, including me? Thank you so much.